Most small business owners check three things to see if they're doing well: the bank balance, the total revenue, and how busy they were this week. Some go a step further. They calculate revenue minus costs to find their gross profit. And honestly, that already puts them ahead of the crowd. But here's the truth. There are actually three specific numbers that tell you if your business is genuinely healthy. And most owners, they have never seen them before. Today, I'm going to show you what those numbers are, why they change every single decision you make, and how to find them even if you hate business finance. I'll also show you exactly what happened inside our plumbing business the moment we found them, including a single job comparison that will completely flip how you think about which work is actually worth taking. Let's look what the research actually shows. A major report by AMP found that more than 1 in 3 Australian small business owners say financial admin is their most single time consuming task. Worse, 2 in 5 say that administration time actively gets on the way of them running their business. Data from Adobe shows that 1 in 5 small business owners are grinding out more than 50 hours per week. And research from Asana shows that knowledge workers spend roughly 60% of their time on what they call work about work, chasing updates, switching tools, organizing work around things instead of doing the actual work. What does that mean? It means you already stretched thin. You aren't avoiding financial clarity because you don't care. You just don't have the time or the right tool to get it. According to the Guidance Financials recent data, only about 57% of businesses are currently profitable. That doesn't mean the rest are failing. It means a massive group of owners are operating in a complete financial fog. And the reason is simple. They're tracking the wrong numbers. To find the numbers that actually matter, you don't need a full accounting degree. You just need 3 metrics. So number 1 is your revenue. This is what actually hit your bank account, not what was invoiced, what was actually paid. This is your starting point. Number 2 is your gross margin as a percentage. This is where most owners get tripped up. Gross profit is a dollar figure, is the revenue minus direct costs. That's useful, but it doesn't tell you if your profit is healthy or if it sits in a danger zone. So gross margin is a percentage. Think about this. You charge $1,000 for a job and your direct costs are $400. Your gross profit is $600. So your gross margin is 60%. That looks the same, doesn't it? And here is why the percentage is what matters. Making $600 profit on a $1,000 job is one thing, but making $600 on a $3,000 job is a completely different universe. So the dollar amount is identical, but the health of the business is not. So number 3 is your floor margin. This is the one almost nobody tracks, but it changes everything in your business. Your floor margin is the absolute minimum percentage your business needs to make on every single sale just to cover overhead and stay alive. This isn't your goal, it's just your floor. Any job that is below that floor actively make you lose money. It doesn't matter if you have invoiced, if the client paid, if the money hit your bank account. You lost money. Without this number, your pricing is just guesswork. You don't know which job to take, and you don't know if a busy week was actually profitable week. Now, normally, you'd have to pay an accountant a lot of money to map this out. But today, AI can help you calculate a highly accurate estimate for free in about 5 minutes using plain, simple language. It doesn't replace a licensed professional, but it gives you a baseline most owners never get. Let me show you exactly what this looked like inside our plumbing business. So in the early days, Dan, my partner, he used to track everything: materials, total, gross profit dollars. He was very organized compared to most traders, but he didn't know our floor margin. He was looking at the dollars, not percentage. But the moment we calculated our floor margin, everything flipped in our business. We suddenly found jobs that looked great on paper, but were quietly draining the business. Now, he checks our gross margin percentage right from his phone before he even drives away from a job site. He's not looking at the bank balance anymore. He's looking at the margin, the real indicator of a business health. So here's an example that completely changed our strategy. So one day, Dan was heading home, and when a small job came through, $150, 30 minutes of labor, no materials needed. Compare that job to a major job we did earlier, $1,900, 3 hours of work, but the parts and materials ate up to 65% of the invoice. Which job sounds better? Most people would jump at the $1,900 job, but the margin on that project was way below our floor. Once you factor in travel, overhead, GST, and so on, it didn't even break even. But that $150 job on the way home, pure labor, massive margin, it contributed far more to the actual health of the business than a project 10 times its size. And we only figured that out once we had our floor margin calculated. That is inside a standard, let's say minimum invoice rule. We'll never give you. The real metric isn't the invoice total. It's the margin relative to time. And you can only see it when you have your floor number. So here's your homework for today. Go to Claude AI. It's completely free, and type this exact prompt into the box. I run this type of business, blank. My monthly fixed costs are roughly this much. I charge per job or per sale this much. My direct costs per job or sale are roughly this much. Help me calculate my floor margin as a percentage and tell me whether my current pricing is above or below it. So just fill in the blanks with your best guess. Even rough numbers will give you immediate clarity. What comes back won't be your financial audit, but I promise it will be more valuable than 90% of the casual financial chats you've had up until now. This isn't about tax compliance. This is about clarity, and clarity is what makes every other business decision possible. So once you know your real margin, the next question hits you like a brick. Why are so many of us charging completely below our floor margin, even when we know we need to raise our prices? That's exactly what we're breaking down in the next video. The actual psychology behind undercharging and the step-by-step way to break out of it. I'm Patty Matos. My background is in organizational psychology. I run real businesses. Hit subscribe so you don't miss the next layer. I'll see you in the next one.